Hey everybody, it's Anthony Zappelli of Signature Premier Properties. Today I got a special guest with me, Steven Koerner with Green River Capital. He's a mortgage broker. Steve, talk to me a little bit about what you've been seeing going on. This market's been crazy with all the negative news when you turn the TV on. I'm sure people, when they go on their social media, they hear all the rates at 7%. It's wild right now, right? I mean, it's like people are like terrified.
Yeah, definitely, Anthony. Thanks for having me. You definitely there's definitely a lot of negative news surrounding us. It's all over the news, a lot of articles. Everything you hear is about high rates and recession and just a lot of hysteria. And listen, a lot of it obviously is real. But what you and I were talking about the other day is really how to kind of outsmart these higher mortgage rates. Do you wait to buy? Do you buy now? And what does that conversation look like?
Yeah, for sure. I mean, even when I have conversations with my buyers, it's like the world's coming to an end, but you have to kind of just educate yourself, and navigate through the waters because, there's never a perfect time, right? We always tell everybody, it's like, not like we have a crystal ball and we can say, hey, this is the perfect situation.
Yeah.
The one thing I always tell when you have to be ready, willing, and able to buy a home. And that's the most important. When you're motivated and you have those factors lined up, then it's the right time, and it's funny because you look at a couple of years ago with all these crazy price swings, multiple offer situations, you can go 50, 60, $70,000 over asking, you're still a backup, right?
Yep.
Fast forward now you don't have necessarily that competition, but now the interest rates are higher.
Correct. Yeah. And you and I were feeling that pain with our clients all throughout that. So absolutely.
Yeah.
You have to think about it this way and well put, everybody's situation is different and there might be a good or bad time to buy a house, but you certainly don't want the interest rates to be the deciding factor. So, just today, a really timely article came out about an hour before this. And essentially what it said was that mortgage demand is actually down to the lowest in like over 20 years, like back to 1997. Now, call me crazy. I actually see that as a great thing, right? So why is that the case? That's the case because interest rates are higher. But what does that do? Values have corrected, not crashed, right? Corrected, okay? As a matter of fact, there's only one time in the last 100 years that you could say that home values crashed. You can use that word. And that was during the mortgage crisis, which was a lending problem. That had nothing to do with real estate, right? So one time in the last 100 years. So if the time is right to buy a property, all the boxes are checked, whatever it may be, you can always refinance. Rates are high right now. They're on average a little over 7%, 30-year fixed. There are ways, which we're going to discuss, to get a lower payment temporarily and put yourself in a position to refinance when the rates do come down, which they will. We'll talk about that.
Yeah, for sure. Absolutely. Yeah. So let's get right into it. Steve, I love your shirt, by the way. Momentum, right?
Keep the momentum.
That's it, man. That's it. All right, Steve, let's get right into the hot seat. So buyers really want to know, with all the crazy news going on, what options do they have right now that they can feel assured that, the world's not coming to an end. They may not necessarily pay that high interest rate that they hear on TV.
Yeah, absolutely. So, so everybody's saying this phrase, which is you marry the home, but you date the rate, right? So it's this sort of buy now and refinance later strategy. And one of the things you can do, one of the programs you can take advantage of is something called an ARM, which is an adjustable rate mortgage. Now it's going to be a lower rate that is fixed for either 3, 5, 7, 10, or even 15 years. The most common ones that I'm writing right now are either the 7-year or the 10-year, mostly the 7. So essentially for that first 7 years, the rate is much lower than a 30-year fixed, on average, at least a point lower, sometimes more. So this is hundreds of dollars savings per month, right? Now, the idea is that you have an exit plan. You're going to get out of this ARM, this adjustable rate mortgage, when the rates come down. And we're going to discuss about when and how the rates go down and some of the predictions on that. But that is sort of a given that they are based on history. So yeah, the adjustable rate mortgage is a great temporary solution to get the payment you're looking for a house that is priced right now.
So Steve, I also hear about interest-only ARMs. Talk a little bit about that.
Yeah, definitely. So ARMs in general, I'm just going to kind of set up the answer. ARMs in general are a little tougher to qualify for than your traditional mortgage. And that's on purpose. The lenders want to make sure that the right people are getting into these mortgages. You don't want to have sort of marginal loans, marginal qualifiers getting into these programs. So you're going to have a certain credit score, debt to income ratio, reserve requirement, things like that. Now, the interest only portion, what that does is it allows you to take a low rate ARM and then also have an even lower payment with an interest only payment. Okay, so I know that sounds maybe kind of wild and maybe a little risky, and for some it is. It's not for everybody, but if someone has a very specific monthly payment, they have a very specific plan with what they're going to do with that savings, and that's the key. And then the third part of this is knowing that you're going to refinance out. So that's just another component, not for everybody, but certainly an option to lower a payment even further.
So Steve, that's great. And now I'm hearing other options as well with the temporary buy downs, right? Tell me if I'm even saying it right. Talk to me a little bit about that, and let's talk to the buyers, how they can kind of really dive in, especially now with the rates, and really get it much more affordable, at least in the short term.
Yeah, absolutely. So, so we spoke about the ARMs and, that being for, more well-qualified buyers. Now, if you don't qualify for an ARM, which I do consider to be the best option, okay, you have something called a temporary buy down. Now, here's how it works. Let's say, let's just use 7.25% as the going 30-year fixed rate right now. So a buyer can essentially ask the seller, or the seller can offer a concession, okay, a credit that specifically goes towards buying the rate down for the mortgage temporarily. Okay, so this is why it's called a seller-funded temporary mortgage rate buy down. Okay, a lot of words there.
Yeah.
The way it works is the most common one, and there's different ones, but I'll talk about the most common one, which is called a 2-1. So essentially, in the first year, the rate is 2% lower, so 5.25. The second year, it is 1% lower, 6.25. The third year goes to the 7.25 that you would have had to begin with if you didn't do this, and that stays for the life of the loan. Again, with the exit plan or exit strategy, buy now, refinance later, to refinance out. Okay, now another question I get, and there's a ton of misinformation on this, Anthony, a lot, and I see social media videos and different articles, and there's a lot of conflicting information. So you have to have a willing seller, obviously, okay, and the buyer is someone who is payment sensitive, okay, so they cannot or do not want to buy this house unless they can get in at a certain level of payment, a certain entry level of payment, okay? Understanding, again, that they're going to refinance out. So now what happens is, when rates go down we're going to get into this, but that's sort of the X factor. When are rates going to go down? Is it next year? Is it 2024? Whatever it may be. If you think about this product, you're covered for 2 years, really. You got that 2-1, you're covered for 2 years. So when the rates go down, and let's say it happens earlier than we're expecting, the question I get is, what happens to that money that the seller is providing for the concession? Well, you actually get a refund back on that. And I saw some major misinformation on that. There are some lenders that don't do that, but the majority of them are giving that money back, and that can be applied towards refinancing.
Yeah, I mean, it's a great option too, because I mean, think about it. This market right now, the competition is not as great as it was, when the markets were overheated and overinflated. So yeah, this is a great time. If you're the only offer in town, you can kind of get creative where, listen, the seller can still net the money that they're looking for, and you can come to a common ground and have it built in. And essentially, from what I'm understanding, it's basically how do you want to manage your money, right? Because it's almost like a seller's concession. So, do you want to manage it, or do you want the bank to manage it for you? But the best scenario out of this is that for the first year of your loan, you said 2% down essentially, and then the next year 1%. And we're going with the premise that the rates are going to go down, and that's where you try to take advantage of that option. So it's a great opportunity for buyers for sure.
Definitely. And rates going down is a when, not an if. And we're going to have another conversation about that and some of the some of the facts of history and projections on that. But yeah, no, I mean it's real savings. I mean, you're talking about $300, $400, $500 a month, even more. I mean, this is in your pocket, help you with your monthly budget, save money for a future refinance, because there is a cost with refinancing. It's a new mortgage. It's not as much as when you buy a home, right? And I just want to kind of back up a little bit and say everything we're talking about right now is not for everybody. I mean, there's some people who should wait to buy a house because the timing is not right. All the things that you interview your buyers very thoroughly about, what are their goals, right? And if they check all those boxes of buying now and they find a house they love, which is less expensive than it was 6 months, 2 years ago, right?
Yeah.
This is the solution, the creative solution to beat these high mortgage rates.
Definitely. And buyers, I hope you listen to this, because again, there is an exit strategy and there's a way that you can still save money. And at the end of the day, we all know real estate is one of the best investments that you can make. On a life with a 30-year loan, you're going to get your appreciation down the road as well. So be smart, understand when the right time is for you, and take advantage of these programs. Let's talk a little bit about refinancing and when is the right time to do it, because we were talking about options that buyers have, examples, the ARM, the buy down programs. A lot of people don't necessarily know what a refinancing is and what it entails and when is the right time to do it. So talk to me, when is the right time to do it?
Yeah, absolutely. I'll answer the timing in a moment, but as far as the process of it, essentially what you're doing is you're taking out a new mortgage to pay off your existing mortgage. So, what does that mean? There's going to be some closing costs. They're not as much as when you buy a home. They're about 50 to 75% of the cost, so they're less. You'll do it when it makes sense. When does it make sense? When a lower rate is out there for you to save money monthly, or if you're in an ARM and you want to get into a fixed mortgage, the rate doesn't necessarily have to be lower. It could be comparable. You're just looking to get out of the adjustable. So definitely the timing of that can be tricky, right? Listen, you can, as a consumer, there are sites where you can track rates. I mean, you kind of can't get away from mortgage rate talks these days, but as my clients, as their professional, I'm watching this every single day, and I can guarantee you that if you're my client, I'm going to get in touch with you before you think it's the right time. Trust me, that's my job. So
yeah, for sure. Yeah, and like I said, open communication is the most important thing. And listen, I mean, how many times do we say in our industry, right? It can be an easy industry to get into, but really the strong survive. And you got to really align yourself with the professionals who can tell you what you need to hear and not necessarily what you want to hear.
Yeah.
Right? Because that's when you can make a really poor decision and potentially cost yourself a lot of money financially. So, not every lender, not every realtor, is upfront, is going to be willing to tell you those things that you need to hear, because some just look out for themselves rather than looking out for the client. And at the end of the day, right, you guys are the clients, the most important.
Yeah. Listen, 20 years in this industry, you're in the industry quite a while. You stay in this industry by being ethical, right? And knowing what you're talking about. So, the one thing I want to say is that, the professionals in this industry have had to reinvent themselves, right? So what does that mean to me personally? So when I do a pre-approval for a new buyer, it's more detailed now. It's everything we're talking about on these videos is I'm going over this with the buyers to not just sort of pitch the next fad, but to actually go over a plan, that exit strategy with the buyer.
Mm-hmm. So Steve, another thing I'm hearing about is discount points. I hear a lot of mixed results about it, especially the different type of markets that you're in. But in this particular market that we're in right now, what's your recommendation on it?
Yeah, absolutely. So, again, I've seen many different cycles of real estate and lending, and discount points, just to define it, it's an upfront fee that you pay to get a lower rate permanently. Okay, so you pay X to get a lower rate. Now, back when rates were 2%, there was a point when they were like 2.5%, right, on a 30-year fixed.
Yeah.
Paying discount fees to get a lower rate made sense, right? Because you're going to hold on to that mortgage. I mean, you're not going to let go of that mortgage, right?
Sure, you better not.
Right. Yeah, exactly. Right. So, but now that the rates are low sevens, high sixes. Okay, so you pay a discount fee to get your rate down to say 6.75, whatever it may be. Are you going to hold on to that mortgage for a while? I'm going to challenge everybody and say no, because the rate is high. You're going to refinance out. Buy now, refi later. So where are we going with this? Discount points are not a good option right now, and there are varying opinions. And I'm just going to throw out the why behind that. So you have to pay an upfront fee to save money monthly. There's something called a break-even point. How long does it take for you to recoup that money that you put up front for the discount fee in monthly savings? Typically speaking, the best case is like 3 years. Typically, it's around 4 years. What are you going to do within 3 to 4 years? Refinance.
Yeah.
Not going to make your money back. So it doesn't make sense.
For sure. That's a good little nugget.
Yeah.
Let's talk a little bit about the VA loan and the different options that you have. We have a lot of men and women who, service overseas and serve our country and really make the ultimate sacrifice. How can we help them out when it comes to buying a home?
Yeah, absolutely. So, I was not in the military, but I come from a military family and have a lot of friends in the military. So thank you for everybody who serves. VA loan is just bottom line awesome. It is such a great loan. Very competitive, low interest rates. You can do 100% financing with no PMI. So, getting that kind of a mortgage is phenomenal. Now, as far as the exit plan down the line to refinance, they have a streamlined refinance program called an IRRL. It's IRRL, and it's essentially a very low cost way of refinancing to get a lower rate. So for the veterans, you have a super competitive interest rate to get in right now, 100% financing with no PMI, and an awesome opportunity to refinance at low cost when the rate's right.
That's great. And honestly, like, I love VA loans. You and I have done VA loans together. It's a great way to help out, the men and women who serve our country. And also too, on my end as a realtor, it's also educating the seller and even sometimes the listing agent, because they look at it like 100% finance. So they don't have any money for the closing costs of down payment. What is this? They don't have any money. How can they buy house? You have to understand what this option is. And it's a great option for them. So I'm glad you have that. I'm glad we have that offer. And if you're in the military and you want to utilize your VA loan, we'll help you out.
Yeah, definitely. I just want to make a comment on that. The veterans do not have to put 0% down. That's just an option. Mm-hmm. And also, this market right now, there are more VA loans being accepted as well as FHA loans because the market has changed. So higher rates have actually, in fact, opened up opportunities, especially for the veterans.
Yeah,